Good evening, everyone. It's lovely to have you all here at our webinar today, again on a very interesting and topical subject on the budget 2021. Let me invite Anand Raghavan, trustee of CIC, to welcome the speakers and begin the session, please. Over to you, Anand.
Thank you, Vanita, and good evening, ladies and gentlemen. On behalf of Chennai International Center, it gives me immense pleasure to welcome all of you to what is a very special edition of Budget 2021. In fact, the title itself is so catchy that it really reflects the content of the budget which has been presented by the Finance Minister recently. It is all about resetting the Indian mindset. But before I really go and introduce you to the speakers here, I just wanted to make two very important statements. And I'm sure that will be the theme on which the discussions today would follow. The first important statement is that we are resetting the mindset in the context that the Government of India firmly believes that what is largely in the public realm of doing business will have to slowly but surely go private. There are enough and more of such announcements in the budget, whether it's privatization of the banks or whether it is the monetization of the assets and so on. But this is a very powerful statement, which I thought was very important and interesting in the context in which we had the title itself. The second powerful statement, and that is why we are actually having this event in a slightly different fashion, is about technology, innovation, faceless assessment, and the whole gamut around technology, which has been well articulated both in the Economic Survey of India and the budgetary announcements, which in effect demonstrates that this is a budget for generation next. This is not a budget of the past. There is not going to be any baggage discussion of the past, but it is extremely futuristic in its orientation and content. And this is the context in which we selected the panelists today for discussing Budget 2021. We have four youngsters who represent really the future of India. Deepthi Deshpande and Arjun Nagarajan are two young economists, early 40s, late 30s or whatever, but they really represent the Gen future economists. They will take us through what would be some of the economic aspects, as would be moderated by Ananta Nageshwaran as he takes over, but they represent the future economists of this country. Deepthi Deshpande, with over 11 years experience in CRISIL, one of the top rating agencies of this country, has a hands-on experience in rating some of the large enterprises, and she will bring to the table her economic perspective on the budget. Arjun Nagarajan represents, again, he's an economist. He works for Sundaram Mutual Fund, one of the most respected funds of a large South Indian Sundaram Finance Group. And therefore, he will give us his perspective on how the economy is shaping up from an investing standpoint. Alongside these two youngsters, we have two Gen Next industrialists. They could be Generation 2 or Generation 3, it doesn't really matter, but they are young industrialists occupying very senior positions in their respective groups and steering the ship, so to say, and looking at this budget, again, from a Gen Next, manufacturing and a textile perspective. Harish Lakshmanan, as all of you know, represents the Rane group of companies, one of the most respected industrial groups in South, in the auto component arena. And he will look at some of the challenges, some of the favorable announcements that have come in the budget, which is going to help propel his group to the next wave of growth. Hari Tyagarajan again represents a large group, textile group in the field of textile and education. He represents Gen 3 of his group and hands-on in what he is doing in his particular arena. And he will take us through what the challenges that he is going to see from his perspective. To moderate, we have none other than V. Ananta Nageshwaran, a very well-respected economist, prolific writer, a part-time member of the Prime Minister's Economic Council, and we could not think of anybody else but Ananta Nageshwaran to look at this budget extremely from a futuristic standpoint. So without much ado, ladies and gentlemen, I hand over now the proceedings to Ananta Nageshwaran to steer the discussion around Budget 2021. Over to you, sir.
Thank you, Anand, and good afternoon, good evening to my fellow panel members, and also to all the people participating in this budget discussion. It's a pleasure and honor to be asked by the International Center to moderate this discussion. As Anand pointed out, the panel consisting of 4 distinguished Indians is flanked by 2 economists and 2 industrialists. So what I'm going to do is to ask the economists to sort of both bring the beginning and the rear, and then have the industrialists in the middle. So I personally don't want to add my 2 cents worth on the budget, because I would be taking as if there are 3 economists, there could be 5 opinions. So it's better to have 2 economists and 3 opinions. So I don't want to add further complexity to the number of views that are out there. The other issue, of course, is some of you might also be simultaneously keeping one eye on the Indian test match scorecard, and that probably explains why at the moment some people might be thinking that India would get to bat before the close of play. I would probably think that you should not worry about it and come and listen to the budget conversation, because that you can watch the full days of play of Indian batting tomorrow. So with those words, obviously my personal view on this budget was one of pure budget numbers transparency, and I would leave it there. And I also mentioned that itself alone can bring down the risk premium on the Indian government bond yield going forward, setting the stage for a capital formation-led investment cycle and a growth cycle, etc. And whether that is going to happen or not, our 2 industrialist friends can actually say that what they hear and what they themselves are thinking of from their respective industry perspectives or from the overall industry perspective, whether they do see the possibility of capital formation happening. And the economists can also spell out what has been done and what more needs to be done in the course of the year. And of course, in our interaction with the panel members, we will be asking them not only about acts of omission and commission, both good and bad, on the part of the budget, and also what they think that the rest of the country can and should be doing to make the budget a success. After all, it is not just the responsibility of the government. For example, we are seeing it in the current agitation and the protests that are going on with respect to the farm laws, that how the terms of reference of the protest keep shifting over the months and years, over the weeks and months, and how different people with obviously neither understanding nor a stake on the outcome lend their voices to the chorus, generally vitiating the atmosphere. So clearly, whether it is economists in and outside the office of government or the general public, how is it that we can help to get the process of the budget ideals and intentions and aspirations become reality? So there will be roughly about half an hour and 25 minute segments between the panel remarks, the panel interaction, and the audience interaction. So with those words of initial remarks, I'm going to ask Ms. Deepti Deshpande to make the initial remarks. Each panelist gets 7 minutes. At the end of the 6th minute, I will generally intervene and tell them that they have 1 more minute left. Please don't take it personal. I would probably cut in if you are taking a longer than 7 minutes, so on. So don't take it personally. Please, the floor is yours now, Ms. Deepti Deshpande. Thank you.
Thank you, Dr. Nageshwaran, and thank you, Mr. Anand, for all the initial introduction. A very good evening to all of you, and I'm very thankful to the Chennai International Center for having me here as part of the panel. A very good evening to all my fellow panelists as well. I think this budget was very different, more so because of the environment under which it came into being. The kind of environment was something that we would see once in a century, as we all know. A big pandemic which caused a lot of destruction, sharpest decline in GDP, and more so a lot of curiosity around what the budget would really do or would have to offer in terms of FY22 per se. I think, in my opinion, 2 choices lay before this government or this budget. First was to ensure that in some way there is support to this nascent stage of recovery, given that last year was more of damage control in nature. The second was perhaps correcting some of the pandemic-induced anomalies that got created in the last 1 year. I feel the budget performed on both these accounts, but in ways different than what most of us expected to a large extent. So for one, if you go to see, the focus of the budget has not just been short term, but it's also medium term in nature. There was hope that there would be something that would be done for the medium term, but I think they've surprised us positively by announcing something on that. There's a conscious choice to tilt towards capex despite walking on a tight fiscal rope. And that provides optimism and creates a platform for growth beyond FY22. But I think what also needs to be kept in mind is that because this is an investment-led push to growth and not a consumption-led push to growth, the full impact of all of these measures will be seen over time and not just in fiscal 22, because it will take time for the economy's productive capacity to enhance and then start showing up in growth. So to that extent, the recovery, at least in FY22, to a large extent will also have to depend on certain underlying forces in the economy, which at the moment are not very strong. The second point that I would like to talk about is what the budget did on ironing out some of the anomalies that arose during the pandemic year. So one, I think if you look at the policy actions, because more so a large part of them were oriented towards supporting the vulnerable or the weaker sections of the economy, there was increased focus in supporting the rural poor with a lot of policy measures that got initiated. Whereas we also know that the urban poor or the urban counterparts also suffered quite a bit of a blow from the pandemic related lockdowns and restrictions. The second thing that we know of is that manufacturing sector recently has been recovering faster than services, especially if you go to see the contact-based services like trade, transport, etc. Now, of course, there was pent-up demand that supported manufacturing, also festive demand. In addition, it is also said that there was a shift of demand from services towards discretionary manufacturing. But if you'd go to see, there were policy actions in place which to some extent were more supportive of manufacturing than services, because like I said, contact-based services would wait for, say, vaccinations, etc. To come into being. The third anomaly is when you look at smaller firms versus larger firms. Now, again, policy did take some initiatives to support the smaller firms, but overall, we know that the larger firms were in a better position to brace this crisis because they have better bargaining powers, better access to liquidity, or even formal channels of finance, etc. Now, these sections in the economy per se did not get direct support from the government or in terms of budgetary announcements. So one can broadly assume that it is growth that is expected to perhaps take care of these scars that have been induced into the economy. However, I think what also needs to be kept in mind is that these segments are some of the large employers. So the trade, hotels, transport, communication subsegment of GDP of the economy is essentially the biggest employer after agriculture, which goes to say that if incomes and jobs and perhaps if sentiments in these sectors have been affected, they would take time to recover. So in FY22, as recovery gradually sets in, some of these sections could constrain demand for a while per se. Now, having said that, the budget does score well on some fronts. I absolutely agree with Dr. Nageswaran when he says that transparency in the budget has improved, and that helps us a great deal. For simply, until last year, what we'd have to do is go beyond the direct budget document and into the internal documents to see what else might total to a fiscal deficit. That's no longer the case, and I think that is not just appealing to the Indians or Indian investors, but also appeals to foreign investors who are now actively investing in India. The second thing is when you look at normalization of expenditures, that was expected. Of course, last year did see some reprioritization away from certain sectors and more so towards others. So normalization of expenditures was one thing that we did see in this budget. But what's also important is in terms of improvement in quality of expenditure. So we have focused on pushing capex overall, even if that is not significantly large. If you look at the overall number, that is the budgetary spends as well as central PSU spends, but still it is higher. Whereas revenue expenditure is expected to come down as a percentage of GDP compared to the ongoing fiscal. So I think, and finally, my last point is, it's interesting to also look at how the budget. Okay. The budget also is thinking of, and the government is also planning to do away with the 3% FRBM target, which was the target which said that the fiscal deficit needs to be controlled at about 3% of GDP. Now, we know that in some ways it's a borrowed target. It's a target which doesn't have a lot of math behind it. And there was a lot of discussion that happened around it. So was it that we were deliberately constraining our fiscal space just because we'd like to achieve that target? But data also shows that in the last 20-25 years, we haven't been able to achieve that target more than once or twice. So doing away with that target also to some extent bodes well and opens up space, some more fiscal space for the medium term. So I think I would like to end with that. I think I haven't gone up to the 6 to 7 minutes, but I think that wraps up my remarks.
You did very well, Deepti, with the time. Thank you very much. I just want to touch upon one question, one remark of yours. We'll come back later on other things. You kind of said that the government hasn't really supported three segments that were very badly affected by the pandemic last year. One is the urban India, the second one is services, and the third one is the smaller firms compared to large firms, because you said maybe some of them will come back better after the vaccination is done, and maybe there is an assumption of diffusion of growth from large firms to small and from manufacturing to services. Is that a correct assumption, or would you have liked to see more done for the directly affected segments of the economy last year?
I think given the government's intention to now give a bigger push to the economy through capex, the overall idea is to, in some ways, do away with, not focus as much on direct transfers. They probably did that during the pandemic hit periods. But now I think the idea or the challenge when it comes to India is also identifying beneficiaries. So for instance, it was perhaps easier and more seamless and prone to less leakages when you look at rural India, because there is a Jan Dhan in place, there is Narega, which to some extent does connect the government to the last mile or the beneficiary ultimately. But if you look at rural poor, it's a relatively vague terminology. So directly reaching out to them would have been difficult. So I think by pushing capex, say in roads, highways, power, and a couple of other projects, there is some intention to create employment for skilled and non-skilled workers, which would benefit both rural as well as urban areas. So I'm myself not very sure how it was possible, given their overall intent at looking at the big picture and medium term.
Okay, we will pick up this thread later in the course of the conversation as well. I now welcome Mr. Harish Lakshman. He should probably unmute himself to share his thoughts on the budget coming from one of the industrial groups in the country. Over to you, Harish. Thank you.
Yeah. So good afternoon, good evening, everyone. First of all, I'd like to thank CIC and Gopal Srinivasan. He's also here for inviting me and giving me an opportunity to be on this panel. First of all, I'm absolutely no expert on this subject when it comes to budget and the economy, and all the more now having two eminent economists on this panel and Anant as moderator. I don't know about Hari, but I've become even more aware of my inexpertise. But having said that, I guess I have the luxury of calling myself a business person, so I can get away with my views that may not be fully factually right. But on that note, a few points from my side. I think overall it's a good budget. It balances the immediate requirements that the country needs, as well as some of the structural long-term things that need to be done for sustainable long-term GDP growth. I think it is focused on the supply side factors, essentially, also addressing things like ease of doing business, improving public infrastructure, and certain structural reforms in key sectors like finance and insurance. And there is also a lot of focus on making India a manufacturing hub. As you know, for a long time we have talked about how a country with our population size needs to have at least 25% of our GDP coming from manufacturing, and we are hardly at about 14%. So I'll briefly touch upon a couple of sectors where I think they've done a good job. One is on the healthcare. Obviously, that's the need of the hour with the pandemic scenario. And I think a significant amount has been allocated in the budget, almost 2.2 lakh crores, double of what was done last year, given the COVID situation. So I think not only for COVID, but also a lot of money is going to augment the primary and secondary healthcare network, the critical care hospitals, the health and wellness centers, etc. There's also increased focus on diagnosis, and the government is going to set up integrated public health labs in all the districts. So I think all this is not only going to address the short-term crisis that we're all having, but also the long-term what is needed for this country. And also the Ministry of Jal Shakti, the allocation of drinking water and sanitation, it's almost up 3.5 times compared to last year. The other significant sector, of course, is infrastructure. Significantly higher capex is getting planned. 2.3% of GDP this year and 2.5 next year. And I think I'm told that the highest in the past decade has been only 1.8%. So a lot of money, higher allocation for road as well as road and highways, as well as on railways. So the other interesting thing to note is the dependence on the capex driven by the public sector enterprise is actually gradually declining. And directly the government is taking on these initiatives, which is also very good for the economy. And the budget also seeks to incentivize private sector investments, as I think Anant had earlier mentioned, by providing new instruments. I think this DFI, as well as allowing debt financing of infrastructure investment funds and real estate investment trusts, etc. The asset monetization of this national monetization pipeline that was announced in 2019. So all of these are again bold, excellent initiatives that's going to make the economy stronger. Now I'll specifically touch upon my sector, the automotive sector. For us, even before the pandemic, we had a very bad year. 1920 was a significant degrowth for the automotive sector, and then COVID struck. And throughout the various initiatives that the finance minister had announced during the COVID period to help the economy, nothing much was done for our sector. So there was initially disappointment. There was a lot of lobbying that we had done about reducing GST rates, and none of that happened. The incentives also were barely there. So there was a lot of disappointment. But having said that, I think most of us in the industry are smiling today. I think the recovery has been very sharp, and it looks like the momentum will sustain. But in the last few months, some significant positives have come about. One is the PLI scheme. Well, it was announced even before the budget. But again, that's a very good step in the right direction. And we are very happy that the auto sector is getting the maximum allocation amongst the various sectors that have been prioritized for the PLI scheme. Especially what's happening globally with an anti-China sentiment. This is the right time for industries such as ours to capitalize on that sentiment and utilize the scheme to kind of take us to the next orbit. Now, I also had the opportunity of being on a panel that made recommendations to the government on the PLI scheme. While the final details are awaited, it is a different approach. Actually, only after interacting with the Commerce Ministry, I could understand that they have actually taken a leaf out of what Korea did in the 90s. The scheme is not for everyone. Generally, that's been the approach. Whatever the government doles out, everyone gets a proportionate share. I think here they've identified they want to take the 50, 60 top auto component manufacturers or the top 5 auto OEMs and give them incentives so that they can reach global levels. I mean, this is what I think Korea did for the Samsungs of the world or Hyundais of the world or Mandos of this world. So the scheme is going to be selective in nature. So many companies are disappointed. But I think the thought process in the government is if you do this scheme, you'll create a few global companies and then many other MSMEs can piggyback on that. So we're waiting for the PLI scheme, looking forward to the details, but it's definitely a step in the right direction. The second, of course, is the Atmanirbhar and the import substitution. And
you have a minute, Harish? Yeah.
So that's again a great initiative, again capitalizing on the anti-China sentiments. The third, of course, is the voluntary scrappage policy that the FM has announced. Again, the details are awaited, but we are definitely hopeful that given that there are 34 lakh motor vehicles and 17 lakh medium and heavy commercial vehicles that are over 15 years and still on the road, the voluntary scrappage, if there is going to be a benefit, and combination of this recertification requirement and the green tax is going to spur demand and improve the environment. Some of the omissions or concerns was, the petrol and diesel prices have been rising, even though globally the prices came down. The government first played around with the taxes, but now they've reduced the taxes, but they've added an agricultural infrastructure cess. So net, there's no benefit to the citizens. And second, we still keep lobbying about the GST for two-wheelers. I think that will help, people lower down in the food chain as well as drive growth. So these were some of the comments, and I'll stop with that. Thank you.
Yeah, that's very comprehensive tour de force, Harish. Thank you very much. You spoke, in fact, you stole the thunder from economists at the beginning by mentioning some of the important schemes such as healthcare and Jal Shakti allocations, etc., infrastructure, which have all long-term implications. So I want to take you up on the comments you made about the fact that 2020-21, when the COVID year, the government really didn't give so much of relief to the automotive sector. Do you think in hindsight, it was a good thing that they didn't do so? Did it make the sector, therefore, become more self-reliant? Maybe it was the real Atmanirbhar in that sense. Is that true?
I agree. In hindsight, I think while we lobbied for GST reduction, the who's who of auto industry was pushing for it. And I think in hindsight, the fact that the government didn't buckle was the right thing, because we're seeing demand back up. Although for two-wheeler, I still maintain a reduction can significantly help the country and the economy. But I think, it was the right move.
Okay. Then you also mentioned about the PLI scheme, and you said you have a better understanding of what they are looking for to emulate Korea, etc. But is the industry in general willing to do its share of what it takes for the scheme to succeed?
I think absolutely. You're right. Oftentimes we are guilty of just blaming the government for everything, but and now we realize that our risk-taking ability also should increase in times of change. I think the entire mindset that I think Anand had talked about in his opening, I think that is definitely changing. This whole the strength of our country, the economy, the mindset that has gotten created in the last 4 years, I think will enable the industries, generation like ours, take significantly higher risks. And these are global risks that we need to be taking, because at least our business is completely globalized today. So, I think you will see that going forward.
You will see the industry responding. That's what you're saying.
Yes.
Thank you, Harish. I now invite Mr. Hari Tyagarajan to share his thoughts from his industry perspective and the overall perspective of the industry in general on the budget. Over to you, Hari.
Thank you, Mr. Nageshwaran, and I thank the Chennai International Center and Mr. Gopal Srinivasan for giving me this opportunity this afternoon. So I think it's an opportunity for two industrialists on the same panel to share somewhat similar names. And as already mentioned by Harish, I think I'm also donning the hat of this one-day economist. So to start off with the macro front, I should say that this budget definitely puts in place a lot of growth schemes, and it is definitely to be seen as a panacea for growth. And the three main economic engines for growth, especially after the country is coming out of a very difficult healthcare situation, the three main areas, including private investment, consumption, and exports, have been given the right thrust in this budget. So I think it's to be welcomed from all quarters. On the same side, I think the fiscal consolidation plans, which were set through the FRBM, have been put aside for a year, and more focus has been given in maintaining the growth and bringing back recovery to the economy, and also maintaining a stable tax regime, and also keeping the long-term interest rates quite stable at this point in time, which will definitely boost industry sentiments. I should also mention the fact that the finance minister, in her budget speech, has definitely put her heart and mind into this budget. When I say heart, the reason I say that is, I think basic amenities, especially for rural India and people living below the poverty line, and also for the average middle class, is definitely a worry about the Human Development Index. And rightly, this budget has made a lot of allocations on the Clean Drinking Water Scheme, the Jal Shakti Mission, and the Clean Air Program, which will definitely benefit some of the heavily polluted cities, and also the thrust given to healthcare, and also the reforms which are being brought in the food and the farm segment. So I think these are very basic amenities which will definitely help India, and especially people from the economic strata. And when I say the use of the mind in this budget, I think the thrust given to infrastructure spending, the recapitalization of banks, and also the thrust given to capital expenditure. So I think these are areas which definitely corporate India has looked forward to in this budget, and we have got exactly what was asked. Now, I think the main challenge is going to be in terms of executing these reform measures, in having a strong ecosystem which will review some of the aspects of disinvestment which have been announced. And I think the insurance sector has also been allowed for 74% of FDI. So I think all this will definitely require more follow-up, and execution is definitely something that is there for looking forward to. As already mentioned, I think ease of doing business, especially on the tax front, where ease of advanced tax schemes, and also opening up of files only up to 3 years and not going back up to 6 years. These are all very, very important changes made to the tax system. And also the National Faceless Income Tax Appellate Tribunal Center, which has been announced, and the Samadhan scheme will definitely, I think, close thousands of tax cases and bring in ease of doing business. And this is all going to be seen in action and just not be considered as good intentions. So maximum governance and minimum government is definitely seen in many quarters in this budget. And quality of spending and efficiency and execution, as I already spoke about, is something that's definitely going to play out a very important role. And I also see that keeping interest rates stable at this point in time. We also had the Monetary Policy Committee meeting yesterday, and also having a stable tax, both in the direct and indirect regime in this budget will definitely, I think, boost corporate earnings, because there is a report that says that 17% of corporates which had better bottom lines in the last quarter, that's Q3, had it because of lower taxes, of lower interest rates. So I think these are some of the key aspects of the budget that interest me. And in terms of my sectors, I would like to touch upon briefly on two sectors. One is on textiles and the other on education. So in terms of textiles, the government had recently announced the production-linked incentive scheme, which has an outlay of about 1 lakh crores, and about 10,000 crores of that is for textiles. Now, I think 1/10 for textiles is something that is, quite good, and it specifically focuses on the man-made fiber and technical textiles, which, definitely need a lot of support at this point in time. And the budget also has an announcement for 7 new mega textile parks, The issue here is there are already textile parks in the country which need attention and care. But the government at this point in time has announced 7 textile parks, and I think 2 or 3 of them might come to the state of Tamil Nadu, which is definitely a good aspect. Now, one dampener which I see is the 10% import duty that has been levied on imported cotton. Now, Atmanirbhar and Make in India, yes, definitely. But there is a huge demand and there's a huge market for fabrics and garments made out of cotton, which are grown in the US and Egypt. And these, fibers have a particular property which Indian cotton does not have. So there is no, import substitution here, and we obviously have to be dependent on these imported fibers. So this 10% duty is definitely going to affect some of the spinning mills, which do import cotton. But the government has also made a provision of an advanced license scheme, which is available for duty-free imports of this cotton if the products are exported. So that is a saver for some of us.
You have 40 seconds, Hari.
And on the education front, I think the government has announced the national education policy, which definitely will give a boost to especially the school education in the country. And I also see the umbrella system, which has been announced in this budget, of having a national research foundation, and that is to be funded with 50,000 crores, and all research institutions will be brought into that one umbrella. And the government is also willing to support the private institutions for R&D and research in higher education institutions. Most of the fundings was going into government institutes like the IIT, but now there is a lot of thrust being given even to the private sector. So I think on the education front, especially in the R&D front, this budget does, give a lot of sops. But I think on the education front, there could have been, more allocations, especially in the, primary education. That's it for now.
Thank you so much, Hari. Like Harish, before you also gave a very comprehensive overview of the budget, not just with respect to your sector, but overall your understanding of the budget. And obviously, I could make out that by and large, the budget impressed you. You spoke about the heart and mind application by the finance minister. I just want to touch upon this point you made, about 2 points. One is you said there are existing industrial textile parks which need attention. So, I mean, to push you a little further, would you have preferred that the budget made provisions more for finding out why the existing textile parks are not doing what it's supposed to do and improve them rather than creating new ones?
Yeah, I think, instead of, parking a lot of money for the new parks, a certain small amount could have gone for infrastructure development in the, smaller textile parks which already exist. The word plug and play was used. So I really wish that it is truly plug and play, because, for example, in India, the government announces a scheme or a park, and people have to go and take an allocation there. But once you go inside, there are so many legal issues. Right. Like somebody says there is a abutting water body, and they go in for a public interest litigation, and it's a civil case which takes forever. Yeah. And I've had an experience in one such parks in Tamil Nadu itself, which have a lot of issues with pollution control. So I think what China has actually done and how China really created size in the textile sector is they were truly plug and play. The government created basic infrastructure like roads, a safe compound wall, availability of water and power, and also a common effluent treatment plant. And then investors were asked to come and invest, and buildings came up very quickly, and the project turned around very quickly as well. Whereas in India, I think there is a long gestation time, and that is what really hampers the growth of such industrial parks which are already existent and the ones that will be coming up soon as well.
So at least your while you would have loved to see some more attention given existing ones, the promise of plug and play new industrial parks does excite you. So the second question I had for you was, you are a bit disappointed with the 10% duty on the imported cotton, because you said the Indian cotton is not a substitute for. So is this, and cotton being a raw material rather than a finished good, you are kind of creating a cascading effect on down the production chain. So in some sense, do you think, therefore, the Atmanirbhar Bharat idea is a double-edged sword?
Yeah. So, what really happens now in the textile market is, textiles is really doing well at this point in time. And there are certain, garments, for example, a shirt that you would, find in a retail store that has a label on the collar that says the shirt is made of 100%, Egyptian cotton, or it would have the brand as Supima. So obviously you will have to, import such fibers to make, shirts and brand them like this. Right. And today there is a lot of, in the textile value chain, there's a lot of importance being given to sustainability, to organic cotton, to contamination control, to contamination-free cotton. Right. And for India to really, I think, integrate with the global supply chain, when the world is looking at us as a China +1 policy, especially for textiles, I don't think we should, have such duties, which might, in the long run, definitely affect our, exportability of products. But right. The, theory behind this is that, very few spinners actually import cotton into India, and most of it is Indian cotton that gets, exported. But I think for having a longer term, role and to have our market shares increased in the global arena, I think this is the right time to make use of, such an opportunity, and this should be relooked.
Thank you, Hari. I think we'll come back on to this topic later. And last but not the least, thank you for patiently waiting, Arjun. The floor is yours.
Thanks a lot. Thanks a lot. Good evening to everybody, and thanks to CIC for the opportunity. There's one advantage when you're speaking last. You said you just have to summarize and give the gist of what you think is the essence. So I think all the panelists have spoken very beautifully about all the specifics. I don't want to really go over all over it again. Just to start off, I'd just say there are three things that I'm very happy about in the budget, and possibly two areas that that bother me. I wouldn't say that concern me, that bother me. One, I think it's a very significant positive, the fact that the government really had that restraint during the COVID phase and resisted the urge to really go hammer and tongs on spending. When emerging markets were doing so, developed markets were doing so, I think that foresight is really appreciable. In hindsight, we're able to appreciate why they did that, the concerns on debt sustainability, all of that. So I think that restraint that the government had, and they waited for that phase of reconstruction to start and give a spending boost, I think that's a very significant positive for me. The second positive is the transparency. I think that really sets the tone, and that costs a fair bit of political capital as well. And it needs a lot of guts for a government to really say, hey, going forward, this is exactly what we're going to do. We will not really do this off-budgeting. We will onboard all the off-budget items. I think that needs a fair bit of conviction and a lot of political capital at a time when things are not really going very much their way, and when spending is always an easy way out. I think that's a very significant positive for me, the second one. But the third one is, due respects to Ms. Deshpande, the fact that the budget sort of echoed a certain commentary in the economic survey. And the budget sort of said to me was that, see, on the rating front, we're really not being fairly rated. So let's sort of put that on pause. Let's not really be too concerned about rating. The priority is growth. Let's push the accelerator on growth, and that will take care of everything else. I think that has been the overarching theme of the entire budget, and I think that's something that's very positive, that stands out to me. These are the three positives that stand out to me. Two concerns. One is the pace of expenditure that they're assuming for FY22. Just fingers crossed that actually does take place. And the second is on the growth pace. We are just warming up for a sprint, a long sprint. So the growth is very dynamic. There are a lot of things that can go right, but there are a more number of things that can really go wrong, especially from a global standpoint. So I'm just hoping that, fingers crossed, that nothing really comes in the way. I have, I think, another minute and a half. I'll just squeeze in a few. I have another minute and a half.
You have time. You have time.
Yeah. So I just squeeze in 2 points here. So the narrative around the budget has really been very, at least from, we look at it from a 30,000 feet point of view, and we look at the macro numbers point of view. There's been a lot of noise about how the year-on-year growth in the expenditure numbers have been really very low, etc., on capex, etc. I think that is very short-sighted thinking, because if you look at the numbers, the year-on-year growth rates is the last thing that one should do in an FY21 year that is a one-off pandemic year. The comparison should be FY20 and not FY21. So I think one should just erase FY21 off the entire page that you're looking at. So FY22 numbers should be compared on FY20 numbers. And if you look at it that way, there's 1% expenditure growth that people are talking about and criticizing. If you're looking at it as a percentage of GDP, your expenditure growth in FY22 is around 15.6% of GDP. FY20 was around 13.2. You can see the extent of spending push that you are actually seeing in FY22. But if you look at the year-on-year numbers, nothing will really be visible. Same, there's been a lot of commentary on capex saying that, see, the budget showed 20%, 25% plus capex. But if you add the extra budgetary resources, it comes down to only 5%. Again, it's the year-on-year problem. You take FY21 and you take off all the one-off COVID-related items, this 5% actually jumps to around 26%. It might sound that I'm trying to defend the government. I know it's not. It comes across that way, but I think one shouldn't look at FY21 numbers at all. One should look at FY20. So I just stop with the last example that you're at the ground floor, you go up all the way to the 4th floor of building, and then you come down to the 3rd floor. So the reference point is not the 4th to the 3rd floor. The reference point is how long have you come? You come from the ground floor to the 3rd floor. I think that should be the reference point. Point of reference should be FY20. Yeah, those are the pointers that I thought I should highlight. Thank you.
Okay, so Arjun, you actually have given a buffer like this government has done in your time allocation. Because this government, I think, provided for a slightly lower revenue growth next year, in 21-22. And also, as you correctly pointed out, the expenditure growth is there. And even the long-term fiscal deficit target is below 4.5%. They didn't say specifically what number. So I think the transparency and the conservatism, both with respect to revenue growth assumption and even the nominal GDP growth assumption, kind of gives us an impression that this government, this particular budget reflects the philosophy of under-promising and over-delivery. So by creating a buffer for surprises, so you also left a 75 or 90-second buffer for yourself to answer more questions. So my question to you is, you spoke about the credit rating agencies not being given that much importance because the survey pointed out, but is it a good thing? Is it a good thing? Because after all, when it comes to emerging markets, the financial industry or financial markets in general treat emerging economies differently than they treat developed economies. So in that situation, is it appropriate to ignore the credit rating agencies?
Yeah. So from a longer term, medium to long term standpoint, I think you're perfectly right. It isn't the right way. But at this point in time, I think it's something like you're caught between the devil and the deep blue sea. If I spend, my deficit goes through, you will see criticism all around. My debt to GDP will go up. And in a matter of 18 months, your emerging market differentiation will go off, because all foreigners who actually look at India from an investment destination will say, hey, you had around 70% of debt to GDP. Now you're going closer to 9,500. I'm concerned. So all those who sort of pushed the government for spending, I'm very surprised that the government really didn't give in, because if they had given in, the same people would have come down 18 months down the line and they would have pointed out that your debt to GDP is so high. Your currency is not something that we are very comfortable with, and let's not really go into India. So that entire narrative would have been turned on the head. So I think the government really saw that foresight was there. So from a shorter term point of view, I think this narrative of not really being bothered about rating agencies, I think would be appropriate. But like you rightly said, I don't think this narrative should continue even after growth comes back. The minute growth comes back, that should be the priority, is to come back to rating agencies.
No, absolutely, Arjun. I think you hit the nail on the head with the emphasis on the medium-term consolidation, because my own personal view, which I have articulated quite a bit in my columns as well, is that this decade is going to be the decade of reconvergence of emerging market growth rates, emerging market economies with the developed economies. So if you look at the first decade of the new millennium, we had convergence. And the second decade, emerging economies actually disappointed. They starved. So India was one of them, which witnessed a slightly lackluster growth rates in the second half, in domestic currency terms, and even more so in dollar terms. But I think this third decade is going to be one of strong growth, again, aided by capital flows coming in from the developed world, because they don't have any options left there. So in that sense, I think to be able to pull back in time is more important. Otherwise, we will repeat what we did between 2010 and 13. And also one more point to supplement what you said about the rating agencies is that I think the government actually, if it ends up doing a positive surprise on the deficit numbers, that may actually be rating positive down the road, even though on the face of it right now, the numbers look as if they are bigger numbers than they should be. I think so you made some very valid points. I just wanted to ask you to repeat the first positive. You said 3 positives. I think I missed your first positives, but the second one was transparency, and the third one was the credit rating alignment with the economic survey. But what was the first positive you mentioned?
The first positive was the fact that they resisted the urge to spend during a COVID period. When I think it was almost like a given that they had to really spend, and everybody was puzzled as to why they weren't spending. Now, in hindsight, it's very clear as to why they really didn't spend. And a lot of interactions that we had in a number of con calls with the government, the point that they kept talking about how it was that when the reconstruction takes place, that is when we will spend. So we were all puzzled as to, okay, what is this reconstruction phase that they're talking about? Because we were actually down in the dumps, for the lack of a better word. So the fact that they really had the foresight to think that, hey, this will also pass, and there will be a period of growth that really ensues. I think that foresight, especially from a government, is something that's really appreciable. Not to really give kudos to the government, but then at least in my limited experience, I haven't really seen this sort of resolve and communication from a government before.
Right. No, absolutely, Arjun. I think you again, I think you touched upon a very valid point. It was not as if they didn't want to spend, but they wanted to spend when it will have more effectiveness. Rather than when it would have less effectiveness with the lockdown and people unable to come out and spend, etc. So even if money was allocated for infrastructure projects, people won't even come to the sites and start doing laying the bricks and tilting the sill in the sand and so on and so forth. Yeah. So bricks, soil, and so on. So I think that was a good point you made. I think all the panelists, I really thank you for your excellent initial remarks. So maybe I should go back to Deepti, if she can unmute herself. So Deepti, let me go back to the important points you made, 2 points you made. The budget ironed out some anomalies, you said. What are those anomalies that were lined out, and what is the significance of those anomalies being ironed out? And the second question I had for you was, some underlying forces were missing. Maybe did I hear you right? What were those underlying missing forces? 2 questions for you.
Yes, thanks, Anand. I think you probably misheard my first point. What I meant saying was that the budget did not iron some of these anomalies which got created in the last 1 year.
Go ahead. Yeah.
And those were essentially the fact that, of course, given the diverse requirements or the dynamism in the economy, it wasn't possible. And like Arjun rightly said, it wasn't possible to cater to all the sections of the economy when the pandemic hit us. But in the course of taking care of some of these measures, it so happened that to some extent, the preference or policy push was more to the rural areas than urban poor, which in fact did not get as much of an income or job support as the rural counterparts did. The second was that probably the seep-through of policies, both monetary as well as fiscal policies, wasn't as much to the smaller firms as perhaps to the larger firms, who could also benefit because of a number of other issues which are beneficial to them. And the third point that I was also trying to make is that if you look at it, manufacturing seems to have recovered faster because of the factors I mentioned, compared to services, which is relatively more contact intensive in nature and which would benefit from vaccination.
So these things you feel impart a downward risk to the growth estimate for 21-22. What is your own growth estimate for 21-22?
Yeah, for FY22 real GDP, we expect a growth of about 11%. And some of these risks that I mentioned are embedded in that forecast for the simple reason that even if we look at this 11% number, it's more so being driven by the fact that we have a very, very weak base. And the first half of calendar year 21 is going to benefit from the global economy doing quite well as a result of stimuli, etc. Plus, we have vaccinations which have come forth in the economy, which are going to help sentiment. But overall, if you'd go to see in level terms, FY22 GDP, even as was put in the economic survey, is just about 2.5% above FY20.
Yeah.
And if we look at a trend on a trend basis, we are still about 10% below the trend. So these are some of the factors which are keeping us from growing at a very rapid speed that is beyond 10%.
That is the question I'm going to come to you, Harish. Obviously, given the medium-term focus that we have, one of the biggest things that obviously in the last 6-7 years, the corporate sector in general has been very busy improving its balance sheet, because the first 3-4 years of the previous decade, a lot of new loans were taken and bad debts happened. So do you think, based on your own anecdotal observations or maybe conversations, do you think that the Indian corporate sector has finished cleaning up its balance sheet?
Well, I mean, I'll have to give you anecdotal comments.
Sure, that's what, I mean, I understand that, yeah.
Because this issue is not that prevalent in my industry. But of course, a lot of the infrastructure, I think the infrastructure, people who've been in the infrastructure business, obviously, there is a lot of cleaning up that has gotten done. And I think some more cleaning up is left. So I think, and I think ultimately growth will solve a lot of these problems, and I see that even in our own business. It's not that we don't have inefficiencies in our factories, things not, the way they're supposed to, but growth hides some of these problems. So I still firmly believe that what this country needs is, 3-4 years of solid growth, 10%, 11% GDP year on year for 4 years, I think will solve some of these problems. Because the more...
And do you see that the 3-4 years of solid growth is coming, or you feel instinctively optimistic about it as things stand?
No, I think once bitten, twice shy. I think back in 2014, 2015, that was new, but then it didn't happen. So therefore, there is a certain amount of cautiousness. But personally, I tend to be an optimist. So I think that, yes, I think this time around, while the COVID really took us down, this catapult effect will likely to, last a little bit longer. I'm expecting and hopeful of, 3-4 years. And if I may take a minute, I also wanted to talk about this Atmanirbhar. I was a little rushed when in the last session. So
sure.
Atmanirbhar is a very good, excellent initiative. See, I think, I'm going back 20 years when we signed up with WTO, and, we very quickly dropped import duties without understanding, unlike countries like China. And therefore, even though we had a huge market potential, and of course we had other infrastructure issues, etc., but manufacturing didn't take off the way it was supposed to. And even here, after Modi became the PM, he made this big Make in India. And for the first 2 years, I think not only he, all of us were lost as to what this was. But I think now it's taking traction. In the last 3-4 years, we have increased budget import duties across all, industry. And he's not talking about completely being Indian owned. I mean, we allow FDI in almost all sectors. He just wants India to become self-reliant, everything to be made in India. and I link that with the population of this country, unless you get manufacturing to 25% GDP, you're not going to be able to generate employment and move people above poverty. So I think they're getting it right. It's taking time, but I think we're heading the right direction.
No, I hear you, Harish, but again, just to deliberately play the devil's advocate, although I am on your side and I want to sort of bring out the nuances, and I think probably I'll pass on the question to Hari as well after I hear you. So one of the concerns we have, and you mentioned Korea as a template for India. So if you read the book, How Asia Works by Joe Studwell, where he talks about how the East Asian economies actually incentivize their manufacturing to become globally competitive. One of the lines he says in that, it is not so much that the East Asian economies incentivized performers as much as they punished the laggards. So in our Atmanirbhar Bharat package, are there good performance indicators, not just pure production numbers, but productivity? And also, are there disincentives or penalties for non-performance, or is it that will it end up purely as pampering the domestic industry at the expense of competitiveness and efficiency and productivity?
No, I mean, being from the industry, I will not be able to agree to that, because the efficiency and productivity part is taken by global competition. Today, even India is a very, very open market, and where the markets we compete in is also open. So I think the competitive forces will take care of that. I think what India needs is that from the government we look forward to is that boost. While I'm no expert whether the Asian model from a pure university research perspective was right, but when I look at examples of the kind of companies that Korea and Japan and even the Chinese have created, they're all been significant. In fact, unfortunately, in India, it's a little too late because we signed up with the WTO. We globalized before we liberalized, unlike some of those economies. Yeah. So to that extent, we are still handicapped. But I think this government is trying to do its bit to compensate for that.
No, I must appreciate the point that you made repeatedly now, which is, by the way, I concur with that, which is that when Arvind Subramanian wrote about India's premature deindustrialization, actually it was caused by India's premature trade liberalization, which I think the developed world did take care of their own domestic capacity building before they liberalized themselves for trade. So in that sense, we probably missed the sequence a little bit, and we had trade liberalization before we developed capacity. So I think that to some extent, I'm sympathetic. So, but let me throw the question to Hari. So Harish said, of course, coming from the industry, he said he has to agree that he has to believe that industry will respond and be productive. But from your own perspective, what is it that industry can and should do, or is it doing to actually increase productivity and efficiency and become globally competitive, rather than looking for tax cuts, subsidies, and lower duties or cheaper exchange rates?
Yeah, I think your question is really a very important one. Ask what you have done for the country rather than what the country has done for you. So definitely, I think applies at this point in time when the government has to take care of a lot more other things, and industries just have to become efficient by 5 or 6%, and they will automatically become profitable and keep their heads above water, especially the textile MSMEs. That said, I think India is definitely well placed. I'm speaking in terms of a textile entrepreneur, because we are the second largest producer of cotton. And cotton being the biggest raw material today, everybody has to turn their head towards India, and Europe as a market is shrinking, and US, is also a very small, manufacturer of textiles. So it is really India and its, I'll use the term competitive neighbors, especially Bangladesh, Pakistan, and now third world nations such as, Vietnam and Sri Lanka, which are also catching up, quite quickly onto the bus. So we are quite, very efficient when it comes to the middle part of the supply chain. So when it is, when you say farm to fork, The same way it is farm to fashion when you refer to the textile value chain.
Yeah.
And India is as I said, the second largest producer of cotton, and we have one of the largest spindlages in the world after China, which can make very fine yarn and convert that yarn into an intermediary product. But we have a deficit of skilled manpower, which the other countries, our neighboring countries, have. And this fabric gets exported as a semi-finished product into these countries, and it gets finished there, into a T-shirt or a pajama or any other garment, and it gets exported from there on. From those countries, which also enjoy a free trade agreement with countries in Europe and US, which India does not.
I'm going to interrupt you and ask you. So you said the deficiency of skilled manpower. Is that a failure of the industry to develop the institutions and therefore have this reservoir of trained manpower? Or is it a failure of the government, or it's a mix of the two? And is that a way forward?
Yeah, there are government schemes. And now there is the Skill India mission, which has been announced recently. And we hope that a lot of the inefficiencies in the previous scheme will be ironed out. But the basic fact here is that people don't take skilling quite seriously. The government has good intentions, but then the people down the line misuse such schemes, and the entrepreneurs also do not invest the right amount of time and resources on skilling. And I think this is exactly what a very small country like Vietnam has done, achieved far higher productivity levels compared to India.
So your remarks do indicate that I think there is something that even the industry can do better in terms of taking advantage of government schemes and constant investing in skilling. So Arjun, I'm going to come to you. There was this mention of setting up a development finance institution. And I think given the experience we have had with IFCI, IDBI and ICICI in the past, what important steps that need to be taken to avoid a similar experience with those three development finance institutions? What would you like to see in the setting up process of the DFI?
To be very honest, that was a point of concern as well that I didn't really talk about, because we are going back to the same old sort of a structure that we had initially started off. Why we moved away from that structure, I'm still not very clear as to why we moved away from that structure and we moved into the structure that we're currently in. So going back to a structure like that, especially alongside the bad bank structure that we're also trying to have parallelly, I'm still a little unclear as to how much of it will really transpire, given the fact that the infrastructure pipeline that they had announced a couple of years ago, the financing aspect of it has only come through now. So that I think is a positive. The fact that the budget does not have only the narrative, they also have the fiscal math and the ways out to sort of justify the narrative that they're talking about. But it's still early days is what I would want to think. Maybe another couple of years for us to get a sense as to how they're going about. I'm just hoping they don't make the same mistakes that we did. So that is a point of concern for me.
It's a point of concern, not that you have specific answers at the moment. Of course, we can make the argument both ways that a specialist institution was in any case required, because banks taking on a longer term funding role didn't exactly do it well, because they don't have the expertise, they don't have the balance sheet to lend for longer term. So you did need a specialized institution with a skill set and a funding liability asset matching better than what the banks had. The only question is management, interference, concentration, risk controls, all these things will come into play. Now, one of the things I heard from, in fact, Mr. Gopal Srinivasan was mentioning in a conversation also, is it an omission on the part of the government? Well, it's a good thing that they didn't raise any capital any income tax rates and levy a one-time COVID tax, etc. But this entire capital gains tax structure, where I think we kind of have sort of rates all over the place between listed, unlisted, between startup or even a private sector, private market enterprises versus listed markets. So was there an opportunity missed to sort of make sure that the capital gains tax actually favors capital formation as opposed to simple portfolio transactions in public markets? Arjun.
Yeah. So two things there. I think it is not incidental that they completely omitted any commentary on COVID cess or any tax or anything of that sort. I think it is not incidental. And I would want to look at it from a broader point of view, in the sense that if you're looking at the fiscal math, we have relied a fair bit on direct taxes for too long. We've tried our best to really broaden the base and increase the tax revenue in that sense. That hasn't happened for whatever reasons. And I think they've figured that if India has to grow, if growth has to really come through, the way out is not really trying myriad number of taxes and really push up revenues. It has to come from either on the indirect tax front. So indirect tax front is quite directly related to the pace of activity, and it's more sensitive to direct taxes than direct taxes. The other bit is, I think they're also looking at the non-tax revenue front much more seriously than they used to earlier. And that is the more sustainable way of going forward.
I'm sorry to interrupt you, Arjun, but the question was the capital gains tax reforms, was it missed out in terms of really incentivizing risk capital formation?
I think at this point in time, I think they didn't want to really tinker with anything on tax because I didn't think they had the space to drop taxes at this point in time. Maybe it could be for the next budget.
Right. So of course we have a few questions already from the audience, and of course the first question comes from Dr. Vaidya of Shastra University. Unfortunately or fortunately, the question is addressed to the moderator. You believe in big banks, and the Indian banking system is still mid-sized compared to global peers. The capex-driven expansionary budget requires a largely banked economy like ours to have a different approach to NPAs. It's like one can have COVIDian symptoms but tested negative. Likewise, borrowers may have COVID-related financial symptoms but are really capable borrowers. Can such firms participate in this budget reform? Or will there be crowding out of capital, leaving behind the deserving many, especially MSMEs? I think his question is whether India's NPA recognition norms need to take into consideration India-specific factors and whether we are correct in accepting Basel norms unquestioningly. I think this is a question probably more related to RBI regulatory policy rather than the fiscal dimensions of the government. And I think it's a very valid question, and some of us have written about it. I do believe in big banks and small banks. I'm not particularly a believer in big banks. So the question is valid. The answer is whether the Indian government, which right now has taken the step on fiscal policy, as Deepthi mentioned, as Arjun mentioned, that we didn't pay so much of attention to the credit rating agencies' concerns, but agreed to give a headline big deficit shock number. Similarly, I think India also, in the monetary policy side, we did not worry so much about the inflation number being higher than the target range, and yet RBI supported growth. So I'm just trying to point out that saying on the fiscal side, on the monetary policy side, we have actually taken a different approach, and hopefully that different approach will come through with respect to the non-performing assets recognition as well. But it's very important at the same time not to use all of this, Atmanirbhar Bharat or a different kind of NPA norm recognition, etc., as signals for lackadaisical approach to credit culture, because we do lack a credit culture, whether it is in the private sector or in the public sector, and also especially payment to suppliers and not just to banks. So in general, the concept of paying your dues, whether it is to suppliers or to the financial institution, that culture needs to develop. So it's a question of when do you sort of feel comfortable that there is a good credit culture in the country and you can move towards a very India-specific NPA recognition norm. It also depends on our economic resilience and size, but the conceptual idea is well taken. Especially with respect to MSMEs, the problem lies not only in their access to finance from the banking system, but access to finance from their own buyers, corporate buyers and government buyers, etc. And that needs to become much more disciplined and regular before we worry about access to finance to MSMEs from the financial system. The question is, one more question again, unfortunately or fortunately, has come to the moderator. I have been an advocate of the need for scale, especially in manufacturing. Are we finally coming out of large firms and foreign capital phobia? I would probably think so. In fact, I would even argue that the corporate tax cut that the Government of India gave in September 2019 was the first sign that the Government of India was actually coming out of the shackles imposed by the Sood Boot Ki Sarkar, sort of the moniker that it had, sort of a burden that it carried. And I think they dropped that burden, they came out of it. And as Harish pointed out, this tendency to now invest in specific industries, specific firms and create global scale, etc. But to create scale, the fear of growth has to go out of the micro and small enterprises. And to that extent, the MSME reclassification norms announced in May, June 2020 or July 2020 don't go far enough. So in that sense, there is still more work to be done in order for the government to truly encourage scale, because those MSME reclassification norms don't really go far in encouraging micro firms to grow into small and small into medium, etc. And I think that's a different topic for discussion later. We will go on to more questions. I'm going to pose this question to Deepthi. Do you think RBI and the Finance Ministry collaborate to make this budget a success? If so, what is your indication that the first monetary policy meeting post-budget itself, does it give you any indication of a Jugalbandi or a discordant, two separate solo performances?
No, I think this particular budget followed right after by the monetary policy essentially shows us flavors of coordination between fiscal and monetary policy to a large extent. So, for instance, what we did see in FY 2021 is, given that the government finances were in a tight position, it was the monetary policy which tried to do most of the heavy lifting. So we did see rates being cut excessively. We did see that liquidity was pumped in at an unprecedented scale. And what that did is that at least to those sections of the economy which were in a position to borrow, which were in the position to benefit from lower interest costs, they could benefit. They had the option of at least benefiting. I think where things stopped moving on or percolating to the real economy in general was because there wasn't too much of a fiscal push that happened in terms of there was nothing that gave us certainty, too much of certainty or positivity on growth prospects. And therefore was something called risk aversion, which was at play. So if we look at the risk premium, even if, we did see interest rates in general come down, we did see the 10-year GSEC yield come down. For the corporates which were below AAA, the spreads didn't come down as much. Then again, if we look at bank credit growth also failed to pick up in a big way. All of that is going to suggest that money was finally not entering into the real economy the way that policies would have liked it to be. So now,
So now going forward this year for 21-22, you see what exactly should the RBI be doing given this budget that we have?
Yeah, I think number one, what the RBI has spoken about is that it would want to be accommodative, continue being accommodative in its monetary policy stance. And I think that is justifiable to the extent that inflationary pressures, especially from the food side, etc., are coming down. But at the same time, I think they will stay vigilant because there are cost push, inflationary pressures seeping into the economy. Plus, it's a year when numbers are going to look very odd. Growth is going to pick up, and therefore there could be some implications on inflation. So, what I'd like to say is that while they'll stay accommodative, chances of further rate cuts are are diminished. There may not be many rate cuts. And one more thing that I'd like to point out before I finish is that the market borrowing program is extremely huge this year. Last year, the RBI managed to keep yields low by pumping in a great deal of liquidity, almost 4.4 trillion on average monthly. But that's not going to be possible this time around because there is growth and because that growth could inflate inflation. So I think yields could be somewhat more firmer this time around on the 10-year bond than they were last year.
Thank you, Deepti. Sorry for interrupting you because of I wanted to get through more questions, and so please don't take it personally.
No.
So I'm going to ask Harish. We had Deepti talking about interest rates being somewhat higher, the bond yields on the Government of India being slightly higher this year. That's what she mentioned. Now, Government of India, RBI also has now thrown open the investment in Government of India bonds to ordinary people like us. You can open an account with the RBI. So will you buy Government of India bond at these yields?
Yeah, I think definitely. I would. While while the interest rates may not go down, from my perspective, as long as they don't go up, and we maintain it in this zone.
That's what she's saying. It's going to go up. That's what she's saying.
Okay, I really hope that doesn't happen too soon. Because, my complaint with, sometimes I find RBI tends to be too hawkish. I've always found in a growing economy, a little bit of inflation is not a bad thing. Maybe I'm ignorant, but...
No, you are not ignorant. You're spoken like a true industrialist, though. So, Hari, among this panelists, you are the only one who is wearing the hat of an educationist as well. And the question is, do you think the budget gave adequate attention to primary and secondary education, or is it a matter not for the budget, but in terms of the outcomes in the entire field of education? So does the answer lie elsewhere, outside the budget?
Well, I'd like to, answer this question by saying that to put the painting on the wall has to be built first. So I think the national education policy, which was announced in 2020, is a very far-sighted policy and a visionary one in terms of not only primary education but also secondary education. So I think the MHRD has really framed a wall in terms of the policy, which is the NEP. And I think in the consecutive or successive years, there would be more allocation to education. That is what I think. But nonetheless, in this budget, an announcement was made that for 15,000 schools in India would be qualitatively strengthened through using all components of the NEP. And I think finer prints have to be read to actually see the impact of that. And another important announcement, according to me, in this budget is that a training program for 56 lakh school teachers has also been put in place through something called the National Initiative for School Heads and Teachers for Holistic Advancement. And the short form of that is NISHTA. So I think for education to really, prosper, we need, fairly good teachers. And this is what some of our government schools in the rural parts of the country lack. And the NEP will also, I think, iron out some of the inefficiencies and bring in, fresh light in the, diaspora of teachers. And I think if we have good teachers in place, they can really, create an impact. And one more thing which I really feel that NEP has also touched upon is, the standard or class 2, the second grade. They have really given a lot of focus, for the second grade, students, because that is where the child really develops basic numeracy and, proficiency of the language. So I think activity-based learning and such things will really improve the foundation, which, I think is important to build upon.
So you are quite positive that the NEP has addressed both the primary and secondary school situation, and this also the initiative NISHTA for teacher training is also good. So I think if I kind of read you correctly, you are reasonably positive about and constructive about the reforms announced not just in the budget but even before that with the NEP.
Yes.
Okay. So I think is the NEP getting implemented? We also saw some announcements by UGC in the budget week, I think, or before that. So is NEP getting implemented with seriousness?
It is again a consideration of the states, because some states have brought politics into it, and there is this language bias as well. So we will have to wait and watch. But I think from the education sector, I think for a common good of the entire nation, I think NEP will definitely do a lot of good. And it will remove some of the route-based learning and bring in more application of mind. And there is also an element of skilling as part of school education itself. So I think these are some things that Indian education system really has to amend itself to kind of produce the right set of next gen youth.
Right. Thank you, Hari. And I think I'm going to come to Arjun for a last set of views. So the government did announce some recapitalization and some roadmap for privatizing strategic, non-strategic sectors and so on. But there was not much of reforms announced with respect to the public sector bank management. Did that strike you as a disappointing thing? Because there was no governance reforms per se. Because in banking being strategic, the government, to use its words, would retain a bare minimum presence. And that bare minimum could be 2 or 3 institutions, and one could be SBI and something more as well. So, but did we see any governance reforms? And do you think that would actually be a big dampener for credit growth? Because risk aversion was cited as one of the reasons, because if you make a loan, if it goes bad, you are pursued into retirement and after by the 3 C's, CBI, CVC, CAG, etc. Is that risk removed, or is it still persistent? And would that be a growth risk for 21-22?
I don't think it'll be a growth risk. Whether I was expecting it, like I mentioned on the capital gains tax as well, I feel it is not a topic that they wanted to deal with in this budget, because governance reform is something that has been going on for a fair bit of time, and realistically it's something that will take time. It is something that that has to really be nudged over a period of time. So realistically, I would have been very surprised if they had spoken about it or introduced that in this budget. So
you are not,
I think it is sorry. So I think it is something that possibly they should bring about when growth is a little stronger.
Better. Okay. So now we have just rapid fire questions to all of you. 10 seconds answer. Of course, nobody is going to, hopefully we will come back to you in 2025 and 2030 to check with you if you got it right or not. So each one of you, 2025, you can choose either dollar or Indian rupee basis. What is your forecast for India's GDP 2025, 2030? Deepti first.
I think in terms of growth, I think on average we should grow by around 6.5 to 7%. It might sound low, but I think it's going to be more of a steady level
GDP
of growth.
size. The question was, what is the GDP size of India, real GDP, by 2025 and 2030? So you said it abscond. Okay. So now next.
GDP absolute number.
Before Deepti comes back, what about Harish?
I think 5 trillion by 2025 is still possible with an 8% GDP.
Okay. And so you will reserve your views on 2030 for the next meeting. Okay. Hari Tyagarajan, please.
I think I'll go for a ballpark of 4 to 4.5 trillion US dollars.
Okay, you are, by the way, Hari, you are in line with the IMF forecast for India. 4 to 4.5. So yeah, it's good. And what about Arjun? Arjun?
I just opened an Excel and got the numbers through. So if you want it in rupees terms, I think I'm looking at 482 trillion rupees. And in dollar terms, I think just around 6.5 trillion. I think this entire...
This is by 2030.
By 2030, because I think what people miss out on this 5 trillion number is the fact that you don't keep dollar constant. Yeah. Dollar keeps depreciating by around 1.5% or so. If you do that, then I think you're around 6.5-7 trillion by 2030. So if you keep it constant, then it's much higher.
You're basically assuming rupee appreciation against the dollar as well.
No, rupee depreciation against the dollar. Yes.
Rupee depreciation. So
depreciation.
As we have experienced in the last 10 years in general.
Yes. Okay. Yes. In the sense that in 2013, if the taper tantrum hadn't happened, he would have crossed 2 trillion 2 years ago.
Absolutely. Absolutely. So good. So you are $6.5 trillion by 2030. This is real GDP of India.
This is nominal GDP.
Nominal GDP. Excellent. So, Deepti, you are back again. So, one last chance.
I think 5 trillion gets pushed to somewhere around FY 26-27, according to me.
5 trillion by 26-27. So, you're choosing a midpoint between 25 and 30. Okay.
Yeah.
Fine. That was my question.
I think the target essentially gets pushed by around 2 years or so.
Okay. So, basically, thank you, Deepti. So, basically, ladies and gentlemen, by and large, you heard our panelists speaking constructively about the budget. I mean, we had Harish talking very positively about the PLI scheme and how the industry would respond to that. Hari Tyagarajan wore both the hats of an educationist and an industrialist. And I think he seemed much more positive about the new education policy, at least its underlying concept, principle, and a lot rides on implementation. We had Arjun speaking about the fact that the government of India, took a bold stance against the credit rating agencies' mindset and willing to move on, and also about the transparency. Of course, Deepti correctly pointed out that the government of India was betting on some of the relatively COVID unaffected sectors driving the growth, such as big manufacturing, big firms, rural India, etc., before hopefully sort of trickling down to services, to urban India, and as well as to smaller firms. And you heard their GDP forecasts. All of them are quite optimistic, and I agree with them. I would also say that the glass is more than half full for India. So the problem, in fact, this decade will be one of managing too much growth and not too little growth. And therefore, again, that's a point which Arjun also made, is that we need to make sure, I think, or probably Deepti or both of them, that we need to make sure that we don't keep the government in play much longer than is needed, because the private sector, as we heard from all of them, is ready, willing, and raring to go. On that note, I hand the stage back to Anand.
Just 1 minute. One clarification I wanted to make, and one question I'm very tempted to ask. That will be the last question.
Okay.
The clarification is about the last question the moderator raised to Arjun about the governance on banks. It's a very appropriate question. I want the audience to note that there is a discussion paper released by the Reserve Bank of India in June 2020, addressing in a very exhaustive manner the entire governance framework for banks, including tenure for managerial personnel and all that. So once that is implemented, along with the reforms in the banking sector, it should take care of the banking problems. So far, so good.
Thank you.
Now, I have one question to Deepti. Deepti, India has always been rightly saying that the international agencies have not understood the fundamentals of India. It's a very valid point, because we have very strong roots, and because of that only our economic policies are built around that. Now, as a credit rater, not as an economist, do you think the rating agencies post this budget and post the RBI announcement yesterday will look at India in very similar way as India is looking at international credit rating agencies to rate it?
I think, Anand, I think number one thing that I'd like to point out is, as a policy, I belong to CRISIL and I'm not allowed to comment on rating agencies and their views. It is our parent company, S&P, who looks at sovereign ratings. So that is number one. But I think in addition to that, S&P, after the monetary policy and after the budget, has also come out with its own view on the budget. And one of the things that clearly gets mentioned there is that they do assign quite a bit of credibility on the fact that transparency has been given some sort of a focus. Like I said earlier, also, the numbers are what they look like, and not much is hidden. So I think that is something that they would look at with more focus. On the ratings, like I said, I am absolutely sorry that I cannot really comment.
No, fair point. And last question to Harish Lakshman. The finance minister mentioned yesterday in the FICCI meeting, the government has done its bit. Now private sector, come forward and do your bit. Your take on that?
Absolutely. I mean, I think many times this government has been right in pointing out that, we tend to just blame them for some of our faults. And I think she's right, and I think many industrialists are now taking ownership of that and correcting that as well. So I think they are doing their bit, and we need to do ours.
Thanks. Vanitha, over to you.
Thanks, Anand. Thanks to all the panelists for joining today. I think it was a fabulous event, and as Mr. Gopal Srinivasan has mentioned, I think Atmanirbharta is in safe hands. Thanks, Anand, for moderating this lovely discussion. And thanks to all the panelists, Hari Tyagarajan, Harish Lakshman, Arjun, and Deepthi for joining today and for all the valuable insights. And our lovely audience, we will meet again for the next event. Thank you so much.
Okay.
Thank you.
All of you.
Thank you, everybody. Thank you.
Thanks a lot.